Greetings, members, one and all of the Salivation Nation. The IMF says that we're about to embark on a crisis like no other that can only bode well for gold. Let's explore. Yes, what you're looking at are the spot prices according to Kitco. And nowadays, well, and really it's been like this for a while. I posted a video about it quite a while ago, but what are the spot prices really? You know, that's sort of another subject, but we see spot prices, futures prices, but essentially, one thing we know is for sure that's consistent throughout all the platforms measuring the price of gold is it's going up. And silver is not too far behind either. So we're taking a look here before we get into the situation with what the IMF said today. The wind is very likely in gold sales as it hits a 7-year high. The overall trend here from this article from CNBC says that gold has recovered the market meltdown losses. Gold prices had surged to 7-year highs on Tuesday as rising fears over the scale of the impending economic downturn continue to drive investors away from risks. Spot gold climbed 1.5% to surpass $1,739 per troy ounce during afternoon trade in Europe, its highest point since October 2012. The precious metal has now recaptured all that ground it lost during the initial broad market meltdown as the coronavirus pandemic spread rapidly last month. The latest resurgence, according to A.J. Bell investment director Russ Mould, could perhaps lay the groundwork for a return to all-time high of $1,900 reached in the autumn of 2011. And we talked about that in a prior video, that anything above $1,700 was really a catapult for $2,000 gold. And I'm more bullish than ever on gold. And I don't want to be, because I want to buy more. This is frustrating because gold is not really acting like silver is in this time. Sometimes when there's this only very brief period of time where gold went down, but only went down a little bit, whereas silver got slammed during that time. And typically that happens before a big, move upwards, which means that I believe that gold will definitely go up to $2,000 if it continues on the trend that it is now, which leads us to this particular story about the IMF warning of the crisis like no other. And if this is being the case, if they're saying this, then, it's all the more reason why gold will probably go up. But again, it's definite that it will go up on its current trajectory. The world is in for a world financial crisis since the Great Depression of the 1930s as the global economy grapples with the Great Lockdown, according to the latest from the International Monetary Fund, the IMF, as is reported here by Kitco News. The expectations now are that the global economy will contract by 3% in 2020, which is much worse than the 0.1% GDP decline seen during the Great Recession of 2009, the IMF said. The economic recovery is priced in for a 2021 with a 5.8% global growth. It is very likely that this year the global economy will experience its worst recession since the Great Depression, surpassing that seen during the global financial crisis a decade ago. IMF chief economist Gita Gopinath said in the latest World Economic Outlook report. Gopinath described the COVID-19 crisis as a great lockdown and told reporters on Tuesday that this is a crisis like no other. The total cost of global GDP could amount to $9 trillion. Wow. And to think, with that, for the global GDP, and here the U.S. government is essentially injecting way more than half of that to try to save stop the bleeding of it, not to even really recover and bring us back to where we were. It's just to stop the bleeding. Canada is expected to be hurt more than the U.S. or Japan. According to the IMF breakdown, a 5.9% contraction is expected in the U.S., a 7.5% drop in 19 European countries, a 6.2% decline in Canada, a 5.2% drop is expected for Japan, and a 6.5% contraction penciled in for the UK. In China, where the virus outbreak started, things are looking a bit more optimistic, with the IMF estimating to see a 1.2% advance in 2020 as the country's economy is already opening up. And it just goes to show you these numbers are depressing for sure. And of course, I really feel bad for Canada and what they're predicting there. But it just goes to show you, if you have a $9 trillion cost of the GDP, and they're pumping out, that's just the United States alone, $6 trillion when you include the 2.2 from this particular phase 3 of the quote stimulus or relief money that's out there. What is the value of those dollars? And I would say that the value of dollars from a stimulus slash relief package are much different than dollars created from hard work and from the engines of the free market. And that just goes to show you that there's that. And then, even as such, what is the value of the precious metals we hold that have surpassed epochs, nations, empires, and through different periods of history? My bet is on the precious metals, gold and silver. Very interesting indeed. The warnings of dire times, as the article continues, to come have been echoed by many international organizations during the past month, including the World Trade Organization, which said that the global trade will contract by somewhere between 13% and 32% this year, with the economic fallout expected to be felt for a long time. Goldman Sachs said it sees advanced economies contracting by about 35% in the second quarter. Even though the number of coronavirus cases worldwide seems to be peaking, it is all based on social isolation, Goldman added. The improvement is probably a direct consequence of social distancing and the plunge in economic activity. Well, that is obvious. I mean, we did this to ourselves. We're shutting ourselves down. State governments and national governments are shutting down businesses by decree, by executive orders and the like. And even if they were remained open, many of us are voluntarily staying in place and social distancing. And really, as we should. This virus is scary, but at the same time, I do worry about the economic repercussions too. We can't do this, but only for so much longer. We're going to have to open back up. And even governors of some larger states are talking about how we're going to do that. What is this new normal going to be? We've got to get the engines of the economy working again, and to get the economy moving before it's too late, before we get into a worldwide depression. It can reverse quickly. People just went back to work. The firm's economist Jan Hatsuis wrote on Monday. But the thing is what does that mean, going back to work? And a lot of this, hotels, entertainment, especially in the entertainment and gatherings of people in close proximity, it's going to be very tough, because even if you open everything back up and no restrictions, how many people are going to come out right now being spooked by this virus? Gold's rally is accelerating. It's been picking up steam amid these announcements, with the June COMEX gold futures last trading near fresh 7.5-year highs at $1,777.70, up 0.93% on the day. Many gold analysts have already compared the precious metals' current trading pattern to that of 2009-2012 bull run, projecting new record high prices for gold in the next several years. When the history of 2020 is told, we expect gold to have been a main beneficiary of unprecedented monetary stimulus that typically supports stock prices. Bloomberg Intelligence senior market analyst Mike McGlone tweeted Tuesday. New highs in terms of many major currencies portend something similar to dollar-denominated gold as a matter of time. In fact, I'm not even paying attention to the stock market nowadays because a lot of that is just injected by Fed dollars going into it, propping up the markets for what they are, giving a false sense. When that being said, we have we're still riding on the Fed-injected stock markets from quantitative easings rounds 1 through 3, with sandwiched in between some real economic growth that we saw, in the times in between there, especially after the tax cuts and less regulations during the Trump administration. But now it's operating under an artificial injection, a real manipulation by the Fed of the stock market at this point. Gold is just beginning its rally, McClone added. Unprecedented global monetary stimulus likely does more to sustain the metal's rise. Gold is outperforming the S&P 500, and the ratio between the two is poised to revert to the higher mean. Scotiabank also weighed in on this, stating that gold prices could see a more bullish run than the 2009-2012 record high period, but warned of one caveat. Sometimes consensus trades aren't wrong. This one is looking increasingly like a Nike swoosh trajectory, floored at 1450. That's likely to be more bullish than the 2009-2012 bull run, but also short-lived, Scotiabank commodity strategist Nikki Shales wrote Thursday. TD Securities is looking for gold to reach new record highs in U.S. dollar terms as well, pricing in $2,000 an ounce for the yellow metal and highlighting rising inflation expectations as one of the main long-term drivers. TD's short-term target of $1,800 an ounce, followed by an eventually rising to $2,000. That won't happen overnight, but we are more than likely not heading to the $2,000 level. I have to say we are getting really close to my $1,800 shorter-term target, TD Securities head of global strategy Bart Melick told Kitco News last week. Plus, if you're a long-term investor, you can't forget about inflation. You have to start wondering what happens if people go bankrupt. Risk is there as a debasement of currency or purchasing power via really low interest rate environment. For long-term investors, we will continue to see moves of money into gold. Another bullish gold forecast comes from Blue Line Futures chief market strategist Philip Streibel, who's projecting gold to average $1,750 in quarter 2, $1,850 in quarter 3, and $2,000 in quarter 4. Gold has been one of the few lucrative investments year to date, up nearly 13% in 22. But I don't look at it as an investment. I look at it as a hedge, just as I do silver, because it's what's going to preserve your purchasing power. It's not there to make you money or even really make you rich. It's just to preserve your current wealth holdings. Gold has scaled levels not seen in more than 7 years thanks to dollar weakness and global recession fears. FXTM senior analyst Lukeman Otunuga. The precious metal remains in fashion. Further gains may be on the cards this week if corporate earnings paint a gloomy picture and the dollar weakens on disappointing data. And I believe that is the kind of the case where it could be. But I will caution, just as they did in this article too, that these big spikes that we're seeing, a lot of it is because of fear, not knowing what's going to happen. I tell you what, for myself, I'm torn whether or not to make another purchase, not only because of the affordability of the case, but also in that, these prices can come back down once the economy does start to open up. There's already talk. There's chatter about opening up the economy in one way or the other. And that could prove bullish for the stock market and dovish for the metals. In other words, metals may come back down a little bit when they see that there's economic activity happening again. We have to take that into account, even though I don't think it's really going to have that much effect, because I think the economic damage is there and not been fully measured yet. And I think when it is fully measured, then I think that'll really drive prices up, even with some revitalized economic activity. It's not going to be a V. I really don't believe it's going to be a V curve type recovery. It's going to be a longer U than most people think. Even if they completely reopened everything on May 1st here in this country and around the world, I believe it's going to take some time to come back into the full swing of things. I hope I'm wrong on that, but I don't think I am. And I think that's going to only prove stronger for gold and silver. And so there you have it. Post your thoughts below. Would like to extend a multitude of gratitude to y'all for watching and encourage you to please rate, share, comment, and subscribe.